Is ADP a buy or a sell? Let's get started with the model. This is a large cap company, 122 billion market cap. They're trading at $297 a share, and they have 411 million shares outstanding. ADP is a payroll provider. It was founded in 1949, headquartered in Roseland, New Jersey. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have really nice, consistent free cash flow growth from 2.5 billion up to 4.1 billion. Really good margins, 16% at the low up to 22% at the high. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also grows steadily each year from 2.9 billion to 3.8 billion. Margins improve from 18% to 21%. If your net profit margin is over 20%, you're doing a good job. Revenue is a sales for the company, and that grows each year from 16 billion to 18.5 billion. They do pay a nice dividend of 2%, which they can cover 1.6 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 105 billion. We discounted those numbers back to today's weighted average cost of capital. We get a value of the company of $94 billion. We divide that by 411 million shares. And we got a calculated stock price at $229. They're trading at $297, so they're trading at a 30% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 101 companies in the same industry as ADP, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 567 million. They have the worst debt to equity ratio. For every dollar of equity, $1.70 of debt. They pay the highest dividend. Most companies don't pay a dividend in this industry. They generate a ton of free cash flow, 4.1 billion. They rank third in market cap, pretty similar to Uber. Price to book looks pretty bad at 23. The calculation is stock price over book value per share. Their PE, price to free cash flow, and price to sales are better than the median, a lot better than the average. For most industries, their PE would not be good, but in this industry, it's actually one of the better ones. Same thing with the price to free cash flow and price to sales. They generate 18 billion of revenue, about half Salesforce, a lot lower than Uber, and their 5-year annual revenue growth rate is 6%, much lower than the median average. And their stock price is $297, which is pretty close to their 52-week high. So you might want to wait on this one till it comes down a bit. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be really happy at $45,000 today. That's a 16% annual return. To summarize, I have them trading at a 30% premium, ranking 8 out of 10. Payroll processing is a really big industry, and they're one of the best at it. I don't know if I would buy a short term, 5 out of 10. Definitely long term. I think it's a great long term hold, 9 out of 10. Ratios are really good, especially when you compare it to the industry median, 7 out of 10. Financials are solid. Not much revenue growth, only up 15% since 2021. But free cash flow is up 60% since 2021. So I give them 7 out of 10. Let's take a look at their income statement. This is the third quarter of 24, third quarter of 23. Their revenue for the quarter is 4.8 billion, up from 4.5 billion. They receive 250 million of interest on the funds they hold. If you use them as a payroll provider, you give them the cash and then they pay your employees. So sometimes they hold the cash for a day or two and of course earn interest on that. Professional employer organization, that's 1.6 billion. They footnote that A. This mainly consists of payroll and then another 3 billion of revenue. They offer a lot of HR features like recruiting and compliance. Below revenue is the cost of revenue. Operating expenses 2.3 billion, R&D 230 million, depreciation 115 million. Cost of revenue 2.6 billion. Then you have SG&A and interest expense. So all their expenses are 3.7 billion. They have a loss of 101 million in other. Earnings before taxes 1.2 billion, 279 million of taxes. So their net income is 956 million. Last year 859 million. And their shares outstanding are going down. Last year, 412 million, now 408 million. So their EPS is much higher. It's 234 compared to 208. Let's look at their balance sheet. Their current assets, 39.9 billion. Current liabilities, pretty much the same, a little less. So current ratio, a little above 1. Almost $50 billion of assets. Their biggest asset are the funds held for clients. You should see a similar liability for this amount. Client fund obligations, $28.7 billion, because the funds are just paid to the employees of their customers. They do have a lot of cash and short-term securities, over $7 billion. Goodwill of $2.4 billion, so it looks like they do acquisitions. Total liabilities, $44 billion. They have $3 billion of long-term debt. They also borrow on commercial paper. Commercial paper is short-term debt, that's $4.4 billion. Assets minus liabilities equals equity, $5.4 billion of equity. They raised $2.5 billion from selling the business. They profited $24 billion from running the business, and they buy back a lot of stock, $20 billion. Treasury stock is a contra equity count, that's why it's negative. Let's look at a statement of cash flows. This is for the trailing 9 months. Operating cash flow, $824 million, a lot higher than last year of $326 million. In their investing section, they had a cash outflow of $1.6 billion. They didn't spend anything on acquisitions. Last year, they spent $34 million and only $3.3 million on PP&E. In their financing section, they had a cash outflow of $6.5 billion. Most of that is pass-through funds to pay the payroll of their customers. They bought $373 million of common stock. Last year, $250 million. Dividends, $572 million. Last year, $516 million. Let's look at a stock on Simply Wall Street. Its last price, $297, $122 billion market cap. It is down in the past week, down about 3%, up 27% in the past year. They started trading a long time ago, back in 1990 at $6. It ran up to 65 in 2000. If you bought it at 65 in 2000, 13 years later, you'd still be at 65. But from 2013 to 2020, it had a nice run up from 65 to 160. Then it came down to about 120 in the COVID bottom, actually about 110, but it's done really well since then. It went from 110 in March 2020 to over 300 currently. Can it keep rising? Definitely in the long term, but there could be some pullback. It's really hard to predict these things. Simply Wall Street values the company at $352. They say it's 16% undervalued. 16 analysts priced this stock at $297, exactly where they're trading at. Their revenue back in 2013 was $10 billion. It took 11 years to double. Now it's almost $20 billion. Not a massive growth, but they're profitable, and that's the important thing. A lot of people like this company for the dividend. They usually pay above 2%. It's been at that level for a while. And the forecast for 2027 is 2.3%. And you can see they consistently raise their dividend each year. In 2015, they were paying 49 cents for the quarter, and now they're paying $1.54 for the quarter. So it tripled their dividend. Even if the stock was flat, you still get your return. But the stock has been going up a lot since 2020, so you'd be killing it if you bought it back then. The CEO's salary was a paltry $529,000 in 2019. He probably struggled paying his bills. Now it's $1.2 million. She probably struggled paying her bills, but now it's $1.2 million. So Maria Black can finally pay her bills. Total compensation $16 million, tenure as CEO 8 years. In the past year, one insider sell, no buys. 83% of the company is owned by institutions, 17% by the general public. And their biggest shareholder is Vanguard, then BlackRock, then State Street. It seems like most stocks have Vanguard and BlackRock as the top 2 shareholders. Wells Fargo, 1.8%, Northern Trust, Capital Research, Walter Scott and Partners, B of A, Eaton Vance, and the bottom out the list, Amundi, the French asset manager. Their employee count is pretty much flat. In 2014, 61,000, now it's 64,000. And their ticker trades on the Nasdaq, Deutsche Börse, Santiago, Wiener Börse, London Stock Exchange, Euro TLX, the Buenos Aires Stock Exchange, and the Sao Paulo Bolsa. So if you want to get a discounted cash flow model, click on the video in the top right corner. Thanks for watching.